Welcome back to Synaptic Dividends. Today we're digging into an absolute giant, Chevron. Now for income investors, this stock is a go-to favorite, but we have to ask the big question.
To figure that out, we're not going to get lost in some crazy, complicated spreadsheet. Nope, we're just going to focus on three crucial numbers that tell you the entire story. So let's jump right in, starting with the company's incredible history.
You know, the first thing you always want to look for in a world-class dividend is its track record, a long history of raising that payout year after year. Well, that's one of the strongest signals a company can send about its health and its commitment to us, the shareholders. And Chevron's record? It's pretty special.
38. For 38 consecutive years, Chevron has increased its dividend. Just think about that for a second. That's through the dot-com bust, the 2008 financial crisis, the big oil crash in 2014, and the 2020 pandemic. Through all of that, every single year for nearly 4 decades, they gave their shareholders a raise. That 38-year streak puts Chevron in a very exclusive club they call the Dividend Aristocrats. And that's not just some fancy title. It's a serious stamp of quality and resilience. But a great history is only half the story, right? The real question is, can they actually afford to keep this incredible streak alive today?
To see if a dividend is affordable, we look at what I believe is the most honest number in all of finance, the free cash flow payout ratio. Just think of it like your personal budget. It tells us exactly what percentage of a company's real, actual take-home cash profit is being spent on the dividend.
And that's the key thing here. This isn't some fuzzy accounting profit. This is the actual cash left over after the company pays for all its projects and operations. So, what percentage of that cash is going to shareholders? For Chevron, the number is, well, it's very revealing.
Over the last year, Chevron's free cash flow payout ratio sits at a very healthy 71.3%. That is a fantastic number. It means the dividend is well covered by the cash the business is actually generating, and there's a comfortable cushion of almost 30% left over for things like buying back stock or just strengthening the balance sheet. So yeah, it's affordable. But how does it hold up under extreme pressure?
And now for the ultimate stress test. How did this dividend do during the worst economic crises of our lifetime? See, any company can pay a dividend when oil prices are high and the economy is great. The real mark of quality is what happens when everything seems to be falling apart.
And this is where the story gets really compelling. During the 2008 global financial meltdown, when banks were literally failing, what did Chevron do? They increased the dividend. And then in 2020, when the pandemic sent oil prices negative for a while, they increased it again. This shows you that for Chevron's management, this dividend isn't just a goal, it's a non-negotiable promise.
Okay, so let's circle back to our original question and put these three numbers together. Let's get a clear final verdict on Chevron's dividend.
So what have we learned? Well, first, we have an elite, 38-year track record of growth. Check. Second, we have a safe and affordable payout ratio of about 71%, which means it's covered by real cash flow. Check. And third, we have proof that this dividend doesn't just survive the worst crises, it actually grows right through them.
So, back to our question. Is Chevron's dividend a reliable cash machine? The numbers, they paint a pretty clear picture, don't they? This is a dividend that is historic, it's affordable, and it is absolutely battle-tested.
Now, these numbers give us some serious confidence in the dividend itself. But if you want to go deeper to understand the full business model, the competitive advantages, and the management team making it all happen, then you should definitely check out our long-form analyses on our main channel, Synaptic Investing.